Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome everyone. This is Jeff Barnes with Angel Investors Network, and this is the Angels, Exits, and Acquisitions podcast. I'm really excited to have you guys here today and to be talking with our guests. Right now, we are all self-quarantined in our own individual office as the coronavirus COVID-19 implementation strategies continue. We'll be talking a little bit about that and what that means for entrepreneurs, the economy, and investing in general. But before we get into that, Erock, how are you doing today?
I'm doing good, my friend, and excited to be staying healthy and and hopefully helping other people to do the same.
Yep, absolutely. And it's kind of funny because this is the longest I have been home, and I can't remember when, and nothing on the docket for the foreseeable future at this point with all the travel bans and everything, all the events that have been shut down. So, bittersweet, of course. We don't want anything to spread any further, but I really do miss seeing people. So it's good to be on a podcast.
Yeah, it's going to be interesting to see what happens when this blows over and the mass entry back into the event space and connecting socially.
Be Woodstock across the globe.
Yep.
So we'll see. All right. Well, with that being said, I want to go ahead and introduce our guest today because this gentleman has had a very illustrious career, living in the Bay Area, working in the Bay Area, and traveling all over the world, doing a lot of interesting and cool things in the tech space. So Dinesh Gauba is a serial tech executive, entrepreneur, and investor. All throughout his career, he's been investing in real estate, oil and gas, angel investing, distressed properties, and so on, learning the ins and outs of investing and how to create wealth for himself long-term, as well as how to create wealth as an entrepreneur. In addition, he's come up with some pretty cool ways to save some of that money through tax strategies and different ways of preventing the government from getting more than what they need and deserve. And I'm sure we'll talk a little bit about that today. So Dinesh, thank you very much for being here. I really appreciate it, and welcome to the show.
Thank you, Jeff. Pleasure to be here.
Awesome. I gave a very brief overview of your career, your path. Could you maybe just spend just a couple of seconds or a couple minutes here and explain to people how you got to where you are today, quarantined in the Bay Area?
Sure. Well, I grew up in Dubai and came to UT Austin for my engineering degree in the mid-90s. And then from there, I started working in the tech space, started off in software and embedded systems, and then moved on from there into semiconductor and video technology. I moved to the Bay Area from Austin, pretty much right at the point when the entire tech bust happened, right about probably 2 months before that, and went through that whole cycle and learned a lot. Was part of different tech companies that went through a bunch of acquisition rounds. We were acquired, then we were sold again. Then I was part of another startup that I invested in, and then that startup got acquired back in 2012. And so it's been a fun ride. And so after that, after getting out of the last startup, I just started to get more involved in investing on my own and just working on a lot of personal development and just trying to find ways to help myself and help others and mentor others and just grow my own set of income streams to just diversify. Because I realized that, once when I was in tech, it took up so much of my energy. I didn't really have time to explore much outside of that. So I kind of enjoyed the time off for a few months to be able to look outside of just tech. Ended up helping start another business in the environmentally friendly, in the eco space, really. We created some products to help wash cars with less than a cup of water, and learned a lot about that industry, and just basically been doing that and just staying educated on what are some of the newer industries and opportunities and some of the problems that can be solved with disruptive technology. So that's something that's of personal interest to me. And then a lot of stuff in the health and wellness space as well, just being, part of my personal development journey. I had a pretty serious car accident about a year and a half ago, and, it's been a journey for me to recover from that. So, it's work in progress, and I'm constantly learning every day. and here I am. So.
Well, good. Well, I'm glad you were able to make it through the accident and come out better on the other side. And of course, we all like to know that we're going to be healthy at the end of something like that. But going through it, I can't imagine it was very much fun.
No, it was definitely a huge challenge to overcome. Learned a lot about myself and just, how to get through stuff like that. So it was definitely a painful but growing experience, and taught me a whole other level of gratitude. So I wouldn't like to wish that on anyone, but unfortunately, sometimes that's the kind of stuff that it takes to go back to the basics. And that brings me back to the current time. And I'm kind of relating this time to when I had to recover from my accident. And it's about what you put your attention on. And right now, it's very easy to start panicking and start, putting your attention on the wrong stuff and overthinking the future. But, I think one of the things that I learned from my experience 18 months ago is that, just focus on the day, just take it a day at a time. Because at that time, I had the same experience. It was unknown. I didn't know how long it's going to take me to recover and how much I'd recover. And, I wasn't able to walk for about 3.5 months. So that was a massive change to my life, given, my normal lifestyle is I'm not usually at home even more than 2 weeks in the month. I'm traveling somewhere. So it was an adjustment period. And so, I think some of those experiences helping me right now, given the situation. And, hopefully it's something that people can keep in perspective.
Yeah, absolutely. And that's no fun. You're exactly right. Like there's a lot of craziness going on in the world out there, and panic definitely doesn't help it at all. So I want to ask one question that, about your journey. You said that you were in the tech space for a long time and had this great career and were part of being acquired and growing a company and being involved in startups. And most people, unless they've been involved in startups or, been part of an acquisition, they don't turn to angel investing. They just don't look at that as really part of a portfolio unless they know something about that. So what was it that really made you think, hey, maybe angel investing does belong in my portfolio?
Well, I mean, just being in Silicon Valley had a lot to do with just constantly being around people that talk about that. That's how companies are built here. Starts off with angels funding and then venture funding. So that whole world of investing, I've been around it for a while. So just, not necessarily been angel investing, but at least hearing about it and learning about it, since the early 2000 days. And, at that time, I was more actively investing in the market and getting more education on the public markets. But at the same time, you'd hear all these stories about startups going public. And so that's kind of how I started to learn about stuff, is got into the public markets and then started hearing about startups and how that process works. And then, just started getting more involved in stuff just through my own work experience, being in a startup and going through that whole process taught me a lot. And then, just constantly learning about it, either being on panels or building relationships with different angel groups or venture capital folks, and just trying to expand my knowledge and my network to get access to, different types of deals. So I'm actually starting to get more involved with the venture side of things as well in the more recent months. So, I think angel definitely has its place. But at some point, you also realize there's only so much money and time that you have, and there's only so many deals you can look at as an individual. And so I've actually, I've developed a lot more respect for some of the venture capital work that's being done in the area, and, how they look at deals and trying to figure out how to collaborate or participate more in those sort of structures as well, because, there's just no way I can scale and look at the number of deals that they do. And so, what I've learned over the time is that it does take you to look at a lot of companies and look at a lot of deals to find the best ones. And knowing that, a lot of them are either going to lose or break even, not a lot of them are going to make it, even though we'd love to think they will.
Yep.
It's about trying to find and diversify enough in your portfolio so that you hopefully do have more winners than losers. That's the goal.
Based on your just personal experience, Dinesh, how many deals do you typically find that you'll evaluate or look at before you find something that you believe is worthy of being investable?
I would probably say not enough. I should look at more. I do look at a lot of deals, but it comes in waves. So it's really because I'm doing it for myself. So I don't, I'm not pushed to keep looking at deals. So I'm not actively going and seeking or trying to source deals. So it's more stuff that comes to me. And, I would say that to look at more deals, I probably need to go and actively source more deals. So I've started to do that more recently by, attending more events and more VC events and things like that, where I get exposure to more deals so that I can do that. But, it's been a mixed bag so far.
So obviously we're in a current situation where the world's going through a little bit of a challenge, right?
Mm-hmm.
From a healthcare perspective. And then you've talked about going through your own personal, challenges based on like your experience and kind of how you went through that accident. And I know it's a little bit different experience, but what's your recommendation for, business owners that are out there, maybe potentially looking for capital? And then obviously with you and your community and your network of investors, what's kind of like the current consensus about, what's going on from an investor perspective?
Okay, sure. Both good questions. I think, maybe to back it up a little bit, I think one of the big things that you realize when you do go through an event like what's happening right now, or what I went through, 18 months ago, is that you really do need to have a diversified set of income streams. And it becomes really apparent and important when you go through something like that, because if you can't work for a while, the last thing you want is, on top of your health stress, is to have financial stress. So, I learned that earlier on, and, I've been diversifying income streams for a while. But, I see a lot of business owners have all their eggs in one basket. They have all their money in either their business or in their 401k or stock market, and that's it. Like, they don't take the time to get educated on alternate assets or, other things that they can do to start building multiple income streams. Obviously, your business is really important, and you should invest when you get a positive ROI in your business. But it's important to take some percentage of those earnings and start to, spread them into different things, because this is the perfect example of it. You can't go to work. If that's the only income stream you have, well, then you're in trouble. So I think that's something that really gets highlighted in a situation like this. And, from an investor perspective, I think right now, this kind of situation is going to really filter out a lot of companies. It's going to show the companies that really understood that concept of using capital efficiently, and, were able to keep their expenses in check, and, be able to get through a time like this. And unfortunately, a lot of companies are living on the edge, just like a lot of the consumers are, and it's going to be tough for them to make it unless they've actually taken that approach all along. And, if you look at some of the best companies that have been built, they were built in a downturn. So those companies, were built in times where capital was not abundant. And so they had to be very, very efficient with it. And I think that's what investors are, also looking for is companies that are very efficient with their capital, whether they have it or they don't, right? So either way, it's more of a culture, and like, how do you actually spend the dollars that you have or that you're going to take in as for investment? This situation that's going on right now is going to help to highlight, those companies that, had that culture of, being very efficient with their capital. And as an investor, you always want to look for companies that, treat the capital like it's their own money, and they run it as a viable longer term business, so that they can survive pretty much any up or down that happens, and have some ability to weather, those storms. And that's what's important, especially in times like this, is, companies that have already been functioning like that. And if you look at some of the best companies that were built or started, they came, out of the 2008 downturn, and they had to be very capital efficient, and to get to the scale that they have today. And those are the companies that will be a good model for current businesses looking to get funded or start, to base it on companies like that have weathered those storms before, or that were started in a downturn where capital was scarce, and people are more fearful to deploy capital, so they're much more conservative in terms of where they put their money.
Yep.
And
I agree with you 100%, Dinesh. And I think there's two main reasons why that's the case. The main reasons why the companies that are started during a hard time are the ones that succeed. And the first comes down to what you're talking about. Capital is hard to come by. It's hard to raise. It's hard to find people. So the entrepreneurs become scrappy. They become resourceful because they don't have the resources that they need to build it. They can't just go to the bank and get a loan, or get $1 million check from somebody just to start an idea. So they have to be very resourceful about that. And I think that breeds into the culture of the company. And the second piece, which I think might even be bigger, but it really depends on the right type of entrepreneur, is when you're in a recession, a downturn, a bad economy, or something like this, where coronavirus is forcing everybody, and entire states and countries are shutting down, and you can't operate the way you always have, it creates an opportunity for a new normal, right? The society has changed, the economy has changed, the way that we communicate, the way that we do business, the way that we get our groceries, everything is changing right now. And there's going to be those companies that are going to take advantage of this and realize that this could linger on, or even if it doesn't linger on, there's still going to be a certain, contingent part of the market that is going to want to do business this way from now on. So if you think about how there were companies that I worked with that they would use technology and they would use energy, not the grid, but they would use IoT devices essentially to determine how much of their real estate was actually being used by employees. We're talking Fortune 500 companies. And then they realized through these IoT devices and the way that the network was set up and the way that the grid and the mesh was set up inside their own buildings, only about 80% utilization rate. So 20% of their real estate costs could go away almost overnight and impact the bottom line dramatically and make a much more profitable company. So I think that is what we're going to see. And we're going to see companies fail. And I hate to say it, but we're probably going to see a lot of small businesses fail as a result of this pandemic. But we're also going to see some incredible companies and entrepreneurs and even investors rise in the ranks in the next 12, 18, 24, and 36 months once they figure out what is happening and what the new normal is going to be. Wouldn't you agree?
Yes, I would agree 100% with that assessment. They say necessity is the mother of all invention, right? That's going to hold very true right now, because what's really important is people can adapt and be flexible with the times, and try to adjust their model or whatever it takes to be able to take advantage of what's coming down the road. So looking ahead, like you said, and looking at those opportunities right now is what's going to determine whether businesses survive or they thrive in the next phase.
Yep. And isn't it funny? We're using Zoom right now to record this podcast, and all I could think about when everything started happening, everybody got quarantined. I've been working remotely for 14 years. I've had my own office, my own house, and I just travel to meet clients and go to events and whatnot. So this hasn't impacted me directly as much as the rest of the world. I mean, obviously business and the economy and society is impacted. So I'm a part of that too. But from a work perspective, being isolated hasn't really changed the way that I do things. But wouldn't it have been cool if everybody who's listening to this podcast had invested in this tiny little company called Zoom back when no one knew about it and it was a private company? And that's the cool thing about angel investing. And I guarantee you that Zoom and some of those delivery services for groceries and other companies that are can take advantage of the convenience and somewhat to a certain degree the isolation are going to thrive in the aftermath of this pandemic.
I would agree. Yep. I mean, the thing about it, the challenging part is, to see that early enough. And a lot of it is timing, and there is an element of luck and also your network to be able to, get access to companies like that. And I know that there's, regulations and changes occurring in regulations to allow more investors, more, non-accredited investors as well to get access to being able to get into those, sort of companies, but it's not quite there yet. But definitely we're seeing more and more changes happen in that space so that there are more people that can get access to companies like Zoom and the likes, right? That are disrupting things, or that can, suddenly become overnight, grow 2x, 3x because of some event that occurs. But it's something that they've been building for a while, and this trend is just going to accelerate moving forward. So the key is to look for, what are the things happening right now? What are the shifts happening right now that, a year, 2 years, 3 years from now will become the norm? And it is an element of timing and luck. I think that's a lot of what it also ends up being. That's why you need to diversify and be able to, make some good calculated estimations or bets on certain kinds of companies that you think are going to succeed. Comes down to a lot of different factors, and macro and micro levels. So I kind of have to look at a lot of those things when I'm looking at companies.
Well, Dinesh, I'm curious. I got a high-level investor friend of mine who sent me some information about the difference between being a peacetime CEO and a wartime CEO, and this was published by Ben Horowitz on Andreessen Horowitz, and the leadership changes that are required, in times of uncertainty where we're at. I'm curious to know, how you think, or what your advice would be, shifting from a peacetime CEO where there's been abundance and things are kind of free flowing capital wise, now going into a lot more scarcity, a lot more challenges ahead, and shifting into like a wartime CEO mentality. Is there any advice or things that you might be able to share on how, small business owners and leaders can make that transition?
It's an interesting question. I mean, whenever I'm looking at companies, I always definitely look for that as one of the key elements, is like, are they already acting like that? And do they treat their capital that way, right? As if it's going to run out, so that they're not, spending freely. I mean, there's a balance between having to spend the money to grow the business and overspending, or even over raising of capital. I've seen, companies go down because they raise too much money, and that can negatively hurt them too. And it's kind of counterintuitive, but it happens a lot in the Valley, in Silicon Valley, where companies just get way overfunded, and it puts a lot of pressure on them to spend the money because investors want to see that money put to work, and it ends up backfiring, and they end up not being able to keep up with the expectations, and it's the downfall of the company, is actually taking in too much money. So going back to your question about wartime versus peacetime, I mean, I think it helps to think about the wartime situation when you're in the peacetime, and a lot of people don't do that. So it's hard to kind of suddenly shift when it happens, because it's not been part of the culture. So, I would say this is an opportunity for all businesses to see, especially ones that were started in the last decade that haven't really seen any kind of a sudden extreme shock to the system or to their business like this one, is to start really focusing on efficiencies and seeing where they can get more efficient in terms of use of resources, use of capital, use of technology, something like what we're doing right now, using this time to really get educated on technology and where they can use it to improve efficiency. There's a lot of things that technology can do that can save you a lot of time and money if done right. And this is in every industry. So I think this kind of situation forces a lot of that on people, and it's a good time to actually, learn about stuff, go and research stuff in your industry. What kind of tools are there? Just this morning I had a call with a company that's developing a tool for one of the industries I'm in, and I had a great 1 hour demo with them and brainstormed on some ideas and some of the challenges in that space that they can start to address. And if we can get that kind of a software for this particular industry, that would save us a lot of time and painful work that we're spending, having people do. So those are the things that I see are going to accelerate in this kind of a situation. The use of technology to do everyday tasks and solve repetitive tasks, anything that can be automated. These are all things to really look for or to go and seek out during this time.
Yeah, absolutely. You said a few things in there that I want to highlight. So, I'm a huge fan of systems and processes and systemizing a business. And systemizing doesn't necessarily mean automating, but whatever you can automate, you do. But you want to make sure that you systemize at a bare minimum and create those efficiencies within your business so that you can operate leaner, right? And I think when you talk about the dichotomy of over raising capital and failing businesses, I don't think people really understand that. Because entrepreneurs that come to us, they say, listen, I've been trying to raise money and I don't have any money. And so that's why I'm going to fail. And you're saying, well, there's plenty of businesses that raise a lot of money, but they still fail. And my assumption is that they get to a point where they say, well, we have so much money, let's just go ahead and, burden ourselves with new office space, new furniture. Let's overburden the payroll and, create all these additional costs that are not necessarily driving revenue. And as a result, it doesn't help increase the value of the company. It doesn't really increase the revenue or the bottom line of the company. And it can be the Achilles heel of these hyper growth companies because they think that just getting more capital in the door is going to solve all their problems. And I'd love for you to just kind of speak to that, because there's plenty of entrepreneurs out there that are thinking all I need to do is just raise more money and I'll be fine.
Yeah, that's a great point, Jeff. I think it's really important, depending on the phase that you're raising money, to understand who you're raising money from and, what their expectations are. And ideally, you want to align yourself with people that understand what you're trying to do and you're raising the right kind of capital. Especially earlier on in a business, it can really kill you if you raise the wrong kind of capital. So whether it's too much or too little, the point is, just having the wrong investor on the team can really hurt a company if the investor's goals or vision of things is not in alignment. So I know it's a real dichotomy, because you want to raise money and you want to raise it from whoever you can at that time, but this is a big contributor to why a lot of businesses fail too, because they either don't raise enough or raise too much, and they don't line up with the expectations of the investors that are giving them the money. And that's what forces certain harsh decisions, especially in the venture cap world. This happens quite a bit. They'll overfund or give companies money, and then they have to start making harsh decisions or doing down rounds on the valuations because, they were super aggressive in the beginning and the companies couldn't grow fast enough into those valuations. So we can probably have a whole other podcast about just that topic and valuations of companies and kind of what investors expect and what the entrepreneur. As an entrepreneur in the beginning, you think the logical thing is, let me go raise as much money as I can. And, I want to give up as little of my company as I can.
Yep.
That's kind of the logical way to think. But if you kind of dig further into that can actually be more damaging to some companies, because you don't necessarily want to overvalue the company very early on, because then it's going to get very hard for you to grow into that valuation. And secondly, it's going to be hard for you to bring in the right investors, especially if you're talking about bringing in any sophisticated or professional or institutional investors down the road, if your valuation's out of whack and you haven't grown into it. So, you start doing stuff like that, then you pretty much hurt your chances to actually raise money down the road. And it's something that most entrepreneurs don't necessarily think about in the beginning, because all they're thinking about is their current round or their current need for capital. And so it's important to kind of map out further out from your current needs and assess what are you going to need, 12 to 18 months from now. And also factor that in and only try to raise what you need to get to that point, as opposed to trying to raise, it's always good to have some extra buffer for sure. Like you definitely, when the money's available, you want to try to get it at reasonable terms. But you want to keep in mind that you don't want to end up overvaluing yourself too early on. and keeping the percentages out of whack in terms of ownership for the investor versus the entrepreneur, because it becomes much harder to raise capital down the road.
Yeah.
And, at least in Silicon Valley, there's some, if you're going to grow a company for scale, you're pretty much going to have to get venture capital at some point. At least most companies do, unless they can, find a way to generate enough revenue to fund their scaling. But most of the time in the Valley, the companies that have become really big have gone to venture. And, when you get into venture capital, they look for certain metrics, and they have some, defined ranges of stuff where they know, in what they're willing to do in like a Series A or a Series B raise. And so, they look at who invested in the initial rounds and, what are the terms for that? And, when they see things completely out of whack, they just walk away from the deals because they just realize that that's not someone that knew what they were doing. So it's really important to get educated earlier on about some of those things and, start building those relationships and start asking the right questions so that, even before you start raising money, you kind of have the plan mapped out and you line things up and you build relationships before you need the capital. I see a lot of people start to do that when they need the capital, but it's like, that's, the time you want to build, you want to be able to take the money when you don't need it.
Right.
And build relationships with investors when you're not asking them for money, right? So that when you really do need the money, they already they're knocking on your door to give you money because they see what you've been doing and you've been, keeping them in the loop on what you've been doing and getting them excited about it so that at the time that you do need some money, it becomes a lot easier to get it.
Yeah.
As opposed to trying to start that activity when you just realize, oh my God, I need some money now. So, managing your cash flow and expectations.
Seriously wise words right there, man. I hope people are taking notes on this.
Yeah, that makes a huge difference. And then I want to go back to one other thing. I know we're running a little bit low on time here, but I want to go back to one other thing you said, Dinesh, earlier, which was, we're in the midst of a crisis right now, and businesses are shuttering their doors, and people are trying to get a bailout. They're hoping for all these different things. And you said, listen, it's really important that you focus on multiple streams of income. And I believe that's actually the name of a book by Robert Allen years and years ago. Multiple streams of income. And every entrepreneur should have multiple streams of income inside their business. Of course, investors, you want to have multiple streams of income. Everybody in this day and age should have multiple streams of income. And when I'm looking at a business, and I look at our business, right? Angel Investors Network have been around since '97. So we've weathered the dot-com boom and bust. We've weathered the financial crisis. Now we're dealing with the coronavirus. And every single time we have to go back and look at our business and figure out, okay, how can we operate in this new world and new economy? And what it comes down to is different distribution channels, different products, different services, and different ways to generate revenue so that you can weather whatever storm might come. And I know from an investment perspective, we're looking at companies and we say, well, how are you generating revenue? If they say we have one product, one flagship product, and that's it. You'll see this on Shark Tank and you'll hear it. And I say, and I know our investors say, it's like, you don't have a business, you have a product. Or maybe you're self-employed and you have one service or one product that you're selling. That's not really a business, because all it takes is one competitor to come in, one downturn in the economy, one legislative act to put you out of business. And I know that's a risk factor for a lot of investors. And I'm just curious what your take is on when you're looking at a lot of, especially early stage companies that they don't necessarily even have revenue yet, and they're only trying to build one product. What are you guys looking at from that perspective to make sure that they can weather a storm like this?
Well, that's a loaded question, because it depends. It's a balance between, you want them to be focused, but you also want them to be able to see the bigger picture. So yeah, you look for really like, what are they focusing on now, and what is going to be their next revenue generator, and that should be very clear. And and then what are they going to do beyond that to expand on that? So looking at the roadmap and what ideas they have, to expand on that. And sometimes those things are going to change along the way. So it's not, no one has a crystal ball. The key is that they're flexible enough to adapt. Yes. And, for example, there might be probably a ton of businesses right now that had to suddenly adapt and shift their business model. Tesla's talking about, using their factories to build ventilators right now. Mm-hmm. I mean, that's how quickly they can adapt, because they have stuff they've done before, in building cars that allows them to have the capability to build other things. And that's what it takes, is having enough flexibility in both your thought process, your mindset, and then also in the company to be able to quickly adapt if things shift. So yeah, you start off with, okay, I'm going to have this one revenue stream, and you focus on it and you make it work, but you're building stuff so that you can expand on that. So you're that's your baseline, but that at some point that you're going to have to adapt or add things to it, unless you're in some certain industries that could work, where you have like key patents and it's very difficult technology for anyone to copy, or it's protected in some way, and you have some kind of a really strong moat that people can't just take over. And there are a lot of companies that have been successful with just one product or service, but again, when things shift, if they don't adapt fast enough, then they get killed, right? So I mean, you can look at a lot of companies like that, right? Look at Blockbuster, the great example. They had this one basically service, and as soon as a disruptive model came, they didn't adapt and they're gone, and they were a massive company at one point.
Yeah, absolutely. I mean, it's just funny. There's so many different lessons littered throughout history on that exact same idea. So I'm really glad you brought that up. And if you're an early stage investor or you're an entrepreneur, I want you to go back and listen to what Dinesh just said 5 more times, because he put a lot of gems in there that I think you guys need to understand. And that's just so valuable for anyone who's either doing due diligence on their own company or doing due diligence on a potential investment. So I appreciate that, Dinesh.
Yeah.
So we are out of time here. So I want to finish up with 2 last questions for you, Dinesh.
Sure.
The first one is, what has been your favorite mistake? One that you've either learned the most from, or kind of glad that it happened, didn't like it at the time, but are glad that you came out of it on the other end throughout your career. And the second is, where can people find you and connect with you?
Favorite mistake. Those are interesting combination of words. I don't know if I have a favorite mistake. Definitely have made a lot of mistakes along the way. I would say the lesson that I've learned is do as much of, you can trust, but verify as much as you can. A lot of times, my mistake has been I've trusted too much, not verified enough, or gone the other extreme where I've, verified or just kept verifying, and then the opportunity is gone. So it's kind of finding that balance where, you trust but verify, and build a good network. I think that's what it comes down to, is, the quality of stuff you get involved in. And, you have to have a trusted network of people or colleagues that are going to help you to filter out some of the mistakes. And it's a work in progress. I've definitely had my share of bad deals and trusting people that I shouldn't have, or, doing it. And sometimes it's just bad luck. You do something and it's with good intent, and then someone on the other end just flips a switch and just decides to do something ridiculous or stupid that takes them down the wrong path. So I've had that experience as well. And so there's no crystal ball, but I would say definitely, that's probably my biggest takeaway has been, trust but verify, and trust the source that you're getting the information from, or where did that relationship or that person come from, and try to improve the quality of sources that you get information from. So hopefully that helps.
Yeah, absolutely.
And I would say to get in touch with me, I'm on LinkedIn. That's probably the best way to look me up on LinkedIn and send me a message on LinkedIn, or even Facebook Messenger, Dinesh Gauba. I'm on Facebook as well, and would be happy to connect and get to know some more awesome people.
Awesome. I really appreciate it, Dinesh. This has been a great call, great interview. Again, we could go on and talk about all these different little nuances for days, probably.
Yeah, I loved the comment about, hey, the capital may not be the right capital. Make sure you get the right capital.
Yeah, I wanted to dive into that one deep, but we just don't have the time. But maybe we'll bring you back, Dinesh, and talk about that a little bit more specifically.
Sounds good. Happy to do that. Thank you, guys. Thank you, Jeff. Thank you, Eric.
You bet.
Appreciate it. Thank you very much, Dinesh. Erock, any last comments?
No, just amazing interview, great insights, and look up and connect with Dinesh on LinkedIn, and hopefully you can get more words of wisdom.
Yeah, I'd just like to share before we end, like these are challenging times for everyone, and it's very easy to get into the panic. And so, watch what you read and listen to and try to be objective.
And trust, but verify, right?
Yeah, trust, but verify your sources of information. And, it's obviously, we don't want to stay in a bubble from what's happening in reality right now, but at the same time, panicking doesn't do anything to help us get through the situation and have a good experience of it. Either way, whatever is going to happen is going to happen. So the way I look at it is, how can I make my experience better? And that goes back to like, what am I reading? What am I watching? And then how am I interpreting that information? And and what am I doing with it so that I can have a positive experience? Am I stepping up and sharing good information with people, or am I just kind of hunkering down and going into a cave and stressing out?
Yep.
So it's really important to watch how your mind, or where your mind takes you during this time, and try to increase your level of awareness of that, so that you can start to expand and not contract. Because in order to grow and to find new opportunities, it's always important to have your mind in a place where it's expanding and not contracting.
Absolutely. Love that. Thank you so much, Dinesh. I really do appreciate it. Stay safe out there, Erock. Have a great time.
Yeah.
You stay safe where you are, and we'll continue operating from our own self-quarantines, and we'll see you guys on the next episode. Thank you.
Thank you.
You've been listening to Angels, Exits, and Acquisitions with your host, Jeff Barnes, brought to you by the Angel Investors Network. Remember to subscribe to this podcast on Apple iTunes or wherever you like to listen to your podcasts. Go to www.angelnetwork.com for tools, resources, show notes, and more, as well as our free training on how to become a successful angel investor and entrepreneur.